Cash flow. So basically, cash flow statement has three sections. One is cash flow from operating activities, second is cash flow from investing, and third is cash flow from financing activities. So in this video, we are going to understand a cash flow from operating activities. So basically, cash flow from operating activities has a three section. First section is adjustment for a non-cash, non-operating. Second, for a adjustment for a working capital, and third is an income tax. Okay, so and so in first section, basically company start from PBT, then comes to net cash generated from operating activity. It was a company core profit cash inflow and outflow from operating activities. So basically in first section, it generally adjusts all non-cash non-operating things, like for example depreciation is a non-cash things. So it separated or down it separated my PBT here, so that's why it was a non-cash expenses, it added it here. So then again, the interest income and dividend income are the two non-operating things. They are the non-operating things. So they basically separated it because they had been added in my PPT. So they basically added here, and this was an item from CFI. So we will go through in next video what is the CFI, but basically it was separated here and added to CFI. Then again the finance cost comes here, which was been subtracted in PBT and has been added because this was a non-operating expense. It is expense. It is a CFF item. Okay. Then again, this was some of the non-cash, non-operating expenses and all those things. And again, this was a once share-based payment expense, which was a non-cash expense. That's why it has been added here. And you can see some net gain arise on financial instrument measure at fair value, which is unrealized gain which has been added to my PBT and subtracted here. So these all the non-cash, non-expense, non-cash, non-operating expense and income has been adjusted. And in second section, we can see operate when from PBT, when I adjust all these non-cash, I get a operating profit before working capital. This also a proxy for EBITDA because the majorly depreciation, dividend, finance, interest, all has been adjusted. The major has been adjusted. Just the the non-cash expenses, not they are just small amount, but this is not a perfectly EBITDA, but it is a proxy for EBITDA. Then we come from an adjustment for a working capital. As we can see, there is a working capital item like a trade receivable, inventory, trade payable. They are adjusted here. For example, it was in positive number, so it's reflect that company has received money from trade receivable. So basically it was in positive number. So in balance sheet you will get it. The trade receivable are decreasing in the current year. For example, in this you can see the trade receivable has been decreased. Again you can see the inventories has been increased, so it will be subtracted in in working capital item. You will, as you can see, the money has the item has been subtracted because money has been stuck into the inventories portion. And second, and again you can see the trade payable here, which has a money outflow of the money. So basically company has paid money to their payables, to their suppliers, so that's why it has been outflow from here. Okay. And then come a cash generated from operating activities here, right? And then we adjust the taxes part and we get the CFO, net cash generated from operating activities. So the company earned PBT of 4,897 crore, but company has generated cash only 4,165 crore from their core business. And in next video, we are going to understand the CFI and CFF. Thank you.